So far, we have seen a knee-jerk reaction in some assets. Where did we see them the most?
Yeah, I mean, specifically, you saw Israeli government bonds underperform today, along with corporate issuers in that country. You saw some widening initially in Middle Eastern countries, but because of the strong fundamentals, most of the Middle Eastern countries are investment grade. They pretty much ended up pretty much unchanged from a spread perspective relative to treasuries. So, I think that you could get a period of risk aversion here for emerging market debt. But generally, this should be a pretty contained concern to the region, maybe with the exception of Egypt, where Egypt may have some more direct linkages to what's going on.
Is that because they're an importer of energy? I mean, when it comes to broader risk for EMs, is it all to do with the transmission mechanism when it comes to energy pricing?
Well, that's definitely one factor that's going to be difficult for them, right? So you're seeing a shutdown of energy for Gaza. There was the news that the Tamar offshore gas pipeline was shut down. Egypt has been struggling so far, really from 2022 and 2023. Bonds are trading anywhere from 40 to 60 cents on the dollar. And that's been because of concerns about high levels of indebtedness. They've been trying programs to sell assets to raise money to fund their maturities. That was going somewhat successfully, but that's really being generated by finances from Middle Eastern neighbors. And so this event may put a pause to that. And then, as you mentioned, with energy, both being an importer, but also as a main repository for refining of natural gas from Israel. They refine a lot of natural gas into LNG. They have the ability in terminals to do that. This year has actually shown very high profitability for that. But with this disruption to Israel, we may see that reverse itself. So, we've been concerned about Egypt for much of the year, and this only exacerbates some of the concerns surrounding Egypt and their ability to continue servicing their debt.
It is an overlay of more uncertainty and a source of volatility, right, for emerging markets, because you're already contending with the prospect of a stronger dollar, potentially even for higher. And I do wonder how much risk or downside risk you assign to China's continued slowdown as well.
Well, the China slowdown has been pretty focused on Chinese property. So we've seen a dramatic drop in really defaults across the board in Chinese property. When you look at, growth projections for China, we're still talking somewhere 4.5% to 5% growth this year. Our view is that the more neutral level of growth for China is going to be 3.5% to 5% going forward. So I think the days of 8% to 10% growth are behind us. And I think that's a pretty well accepted view. But the other thing, too, is that much of the Asian region is doing reasonably well. So Indonesia, Philippines, Vietnam. And part of that is just continued robust growth in the U.S., a little bit of the nearshoring, or at least the diversification of supply chains away from China. So, we don't really think that China is a huge concern relative to the region. And, we think that emerging markets will continue to be supported by what has been reasonably strong fundamentals, but tight valuations so far.
Yeah, that's interesting. So does that mean you're seeing or have seen, I guess, a steady decorrelation between broader EM assets and how they trade? Because, at one point, pretty recently, they were still pretty well anchored to China and Chinese assets.
Yeah, I mean, one of the main themes in emerging markets was the broadening of trade with China. So 15, 20 years ago, much of, say, Latin America was trading directly with the United States. They diversified out to Europe, and now it's gone to almost a third to the Asian region. So it's been a good boost because it helps to diversify out their trade channels. But on the flip side, I mean, I think that one of the things you've seen this year is that emerging markets has been very resilient. When you look at spreads relative to treasuries, spreads are pretty much unchanged on the year. So all of the negative return that you've seen in investment grade sovereign debt has been fueled by the rise in U.S. interest rates. And when it comes to either lower rated sovereign debt or corporate debt, which has been performing very well, they've got a positive return this year. As you've earned the incremental yield that you get over treasuries, and fortunate for corporates, you have a shorter duration. So that's been a benefit for them as well.